Joining us right now is EY Global Divestiture Advisory Services and Transaction Support Leader, Paul Hams. Great to see you, Paul. Thanks so much for joining us.
Thank you, Maria.
What
nice
has been the reaction in terms of corporate America to this uncertainty about China?
You know, honestly, Maria, there really hasn't been that much of a reaction at all. I think most companies really see a lot of the tariffs and a lot of the activity right now is very temporary, right? And they're moving forward with their plans, right? A very rigorous portfolio review process that's already in place in a very resilient and competitive market has not changed the dynamics at all of companies that are looking to divest and do deals.
It's interesting because some people think that the markets are underestimating the threat here, because the markets too, well, we have seen a really big, a pretty good sell-off, and you mentioned the other day Apple is down, what, like 11% in a month. We've seen some specific situations, but for the most part, the markets are expecting at some point something will get done, and this is all noise and negotiating.
Right. That's exactly right. I think most people, as I said, see this as very temporary, and something will happen. And I think people realize that China and the U.S., they've got to be stable and predictable trading partners, and they believe those two largest economies in the world will work that out.
Yeah. You know, Paul, last year we saw divestitures on a dollar basis at an all-time high. I think your surveys are suggesting that will continue this year, next year, and beyond.
Correct.
So a couple of things, your opinion, is that the result of activists going after these companies to divest, to get cash? I'd love to see it go into technology and R&D versus stock buyback, right? And or is it because private equity has so much money, the multiples are so high that corporations say, now's the time to divest? They're getting 10, 12, 14% multiples.
Absolutely.
What are you hearing?
Well, those are all great points, Bob, and they're all true. First of all, I mean, we have companies that we know from our survey now 2/3 review their portfolio twice a year, right? That's significant. So portfolio reviews are no longer an event. They're a strategic allocation of capital within an organization. We also know, to your point, that activists are out there. Activists are certainly driving some of this activity. That's not expected to go away. We also know that private equity is sitting on a record, right? A record of dry powder, over $800 billion of dry powder, right? They have got the capital to put to work. And we know from our survey as well that companies turn around, over 60% of them turn around and invest, to your point, in technology when they have proceeds from a divestment.
Yeah. In the most basic layman's terms, though, are CEOs under pressure to look like they're doing something? If they can't grow the business organically, again, I can think of some companies with new CEOs, and they go in and they start just making moves, divestitures being one, just to look like they know what they're doing when they don't.
Well, there's always some of that, right? I mean, and everything is case by case, right? You have to look at each specific organization and what somebody may be looking to do. But
I'm not asking you to name names.
No, and I wouldn't. But you'd have to look at that. But at the same time, right? I mean, portfolio reviews, as I said, are no longer an event, right? There's something that companies see helps them allocate their capital strategically, and freeing up that capital through divestitures is a way to do that when you have businesses that are no longer core.
Yeah, I think Dagan's right. I mean, I think you're seeing CEOs, some of them are buying earnings per share by divestitures, and some, to your point, 6% investing in technology are trying to get it through core growth, product innovation, right? And so I think that's an important thing to monitor, Paul, as we go forward.
Well, absolutely.
Would you agree?
No, I absolutely agree, Bob. And I think the other thing, I mean, a lot of companies are struggling with, look, I've got to adapt to changing consumer tastes. How do I do that, right? How do I continually involve my business model? How do I invest in technology? There's a buy versus build, right? And a lot of companies are choosing to free up that capital and buy versus build that technology that they need.
Yes. Paul, is this is the spike in divestitures, is this a short-term thing, a phase, or do you see this as a trend that's going to continue for the longer term?
You know, it's a good question. We see it as a trend that's going to continue. You know, our survey goes out through 2021, to Bob's earlier point. But if I look at our pipeline, I look at our conversations that we have with clients, and I look at how the market dynamics have changed over the course of the last 10 years, everything points to this phenomenon continuing.
You mentioned buying technology. I think Walmart buying Jet.com will, even now, we look back and say, and remark upon how that was such a strategically important move for Walmart.
Absolutely. Well, it revolutionized their business model.
It really did.
Allowed them to compete with Amazon. Right?
Oh, do you think the other trend is, in the past, conglomerates were in favor because you had, you know, the optionality of cyclicality in various businesses? I know the company we were from, General Electric, was premier at being able to take advantage of the different industries that they participate in. Today, conglomerates are falling out of favor. I think the activists are really forcing them to get more focused and less diverse. Is that another trend that's happening out there, just overall?
No, absolutely, Bob. It's a great point, and we've seen that. I mean, we've seen the starbursting phenomena, some could argue, going all the way back to 2011, right? And it continues today, and there's a lot of reasons for that. And I think the primary reason is there are a lot of studies that will show that conglomerates trade at a discount of 5 to 15%. I mean, that's significant. So the sum of the pieces is often worth more than the whole.
Yeah.
And it's the danger of one brilliant person putting this conglomerate together, and that individual is the only person who knows how to run it potentially.
Yeah.
And again,
Absolutely.
it's the Otto von Bismarck of core CEOs, where Bismarck created a Germany with a political structure and relationships around the world that only he could manage.
It takes a special person to be able to run a conglomerate like we had with Jack Welch.
Yeah.
That's who I was talking
Absolutely.
about.
Naming names.
Oh, it's great to have you. Thanks so much for your insights.
Thanks for having me.